This is Kurt Nielsen at eMortgage Hawaii, and this week I'd like to discuss whether or not Hawaii is facing some type of housing bubble. Is it fact or is it fiction? Now, many weeks ago, I watched a panel of real estate experts and economists on a Honolulu TV channel talking about whether or not we are facing a housing bubble. And one or more of those experts believe that Hawaii is, in fact, in a bubble and that the bubble is about to burst. So we're going to talk about the facts and go through a study of why that is not correct. So let's just start off. Let's start off with a definition of what a housing bubble is. And this is the best definition I could find. It's a temporary condition caused by unjustified speculation in the housing market that leads to a rapid increase in real estate prices that is unsustainable given current escalation of household income. So that's where we wanted to really focus our attention is on the supply and the demand of housing and whether or not it is sustainable. So let's start off on the demand side. This is a nationwide, and I will dial it down into Hawaii, but this is a nationwide chart of existing home sales, which is really the leading indicator of demand. It represents about 90% of the housing market. So right now, we have achieved an annual pace of sales of 5.71 million home sales a year. That's the highest number in 10 years, dating back to 2006, 2007. And right now, we have a year-to-year increase in median home price of over 6.8% a year. This is an extremely strong number. It outpaced any expectations and shows that the housing market still has extremely strong demand, even though housing prices have been going up pretty steadily between 5 and 6% nationwide, and that number is about the same here in Hawaii at about 5% year over year. So one would argue that even though a lot of millennials are not even in the market, demand remains extremely high for housing. Now let's look at the supply side. Housing starts, this chart shows housing starts from 1950 to 2016 and just into the early 2017. We have finally achieved annual housing starts of 1.25 million starts. This is still a 250,000 short of the number of homes that we need to be building every year to keep up with population in the United States. So you can see that we still need to increase housing starts by another 250,000 just to keep up with the population growth of the United States. And we've been so far behind. If you look at the housing starts, going back from 2007 to present day, we are extremely far behind, and that's why inventory is so extremely tight. And you can look back in history. We've had periods where housing starts were rising for a 25-year period. There are a little bit ups and downs during small recessions, but overall, housing starts from like 1991 to 2006 rose pretty constantly for 25 years. We could see the same thing here in this economy. We could see housing starts rising for another 10 to 15 years just to catch up with demand. So right now, if you just look at it from basic economics, demand is still way ahead of supply in the housing market nationwide. Now let's take a look at Hawaii. Hawaii is in an unbelievable different position. So back in 2005, 2006, we reached housing starts of about 6,500 a year. Right now, we're building about 2,000 a year. So we're at 1/3 that pace. So when I look at this chart, we're not even keeping up with population growth here in Hawaii. And the major reason for this is lending, is builders cannot go to the bank, get a loan to build a spec home. They're just not available. And a lot of builders that went through the downturn had a lot of financial problems. So when the banks do look at them, they might have had a bankruptcy or a foreclosure several years ago. They're not going to lend to them. So all of the housing starts are either being uh, built by big corporations that can go to Wall Street and get money to construct homes, or uh, it is custom home building, is a family who buys a lot and wants to build a house, and they go to a contractor to build. We've really eliminated about 1/3 of the construction market by eliminating the mom and pop speculative home builder. And if the banking industry doesn't start lending to these mom and pop builders, I believe, especially here in Hawaii, that our inventory is going to stay well behind demand for the foreseeable future. And I'm looking at maybe 5 to 10 years that we're going to be behind in inventory here in Hawaii unless we really do start building homes at a greater pace. And the best way to build homes, or increase home starts, is to start lending to the small home builder. And again, that's a banking issue that I don't know if it's going to change. Maybe if Dodd-Frank gets overthrown or there's some changes in Washington with the restrictions on the banking industry. So again, from this vantage point, inventory is going to stay extremely low here in Hawaii while demand is increasing. Okay, so let's look at this idea that we can't sustain the current rise in medium home prices. Okay, so for the past 49 years, if you take in all the recessions and all the ups and downs, home prices have grown at 4.9% annually on average for the last 49 years. Last year, Hawaii was up around 5.0%, so right in line with that kind of growth. So one would argue that we can at least sustain a 5% annual growth in the median home price virtually forever. And I'm going to show you that mathematically, if we can sustain a 1 to 2% increase in household income, we can easily sustain a 5% growth in median home price. So when you hear news reporters say that housing prices are going up 5% while incomes are only going up 2%, and that can't be supported for any length of time, they're completely wrong. They just don't understand the mathematics and the benefit of leverage. Okay. Now, if you look nationally, like we've said, nationally home prices are up a lot more than in Hawaii. And just in March, it was 6.8%, but over year from 2015 to 2016, they went up 5.6. Now that might cool off a little bit, but I believe that a 5% growth in housing is very healthy, very sustainable, and in Hawaii, we'll probably exceed that just because our inventories are so low and home construction is so far behind. So if you look at the just the statistics around Hawaii, Oahu from 2015 to 2016 showed a 5% increase year over year. It's healthy, very sustainable. And if you look at the last 10 years, we've only risen 1.4% because we were trying to recapture part of that decline that we had from 2007 into 2010. So certainly Oahu medium home prices are not escalating so quickly that they can't be sustained. Big Island, you look at the outer islands, only a 0.3% growth in medium home price. But the truth is, when you tear that number apart, actually almost every area is very healthy and more in the 5% increase range. The medium home price got distorted on the Big Island because there were a lot of sales on the low end on the south and east sides of the island. So Big Island market by market, if you look at these or micro markets, is really doing pretty well in the 5 to 6% range. Kauai only showed a 2.1% year over year increase, but that was on the heels of a pretty big year from 2014 to 2015. So maybe, just the market was just catching its breath. But probably will return to a sustained 5% year over year growth on that island as well. And then Maui was up 9.7% year over year. That's a little high, but again, each island's a little different. Maui had a very slow growth from 2014 to 2015, so maybe they're just kind of catching up a little bit. Again, I think if you look at it, statewide, we have been following national trends of that, 5.5%, 6% growth in medium home price. Now, let's talk about household income. Now, nationally, household income was up 2.4% year over year. Now that's very strong. And a lot of times what happens is the reporters don't understand the difference between real income growth and nominal income growth. I'm talking about nominal income growth. How much does your paycheck go up year over year? What you would want to see at the very least is your median household income stay the same year to year. That means when adjusted for inflation, you're not losing any ground. But when we look at the numbers in home affordability, we always look at nominal income. So nominal income nationwide again is 2.4%. On Hawaii, we doubled that virtually, 4.7% year over year. So Hawaii had a very good year with medium household income. And my opinion is that will probably continue, maybe not at that pace, but if we could stay in the 2 to 2.5% range, we would easily sustain a 5% growth in medium home prices virtually forever. Could go on 100 years that way. And I'm going to show you the mathematics of that. So I'm going to take the most aggressive example of why we can sustain higher housing prices virtually forever based upon a small increase in household income. So the way I'm doing that is I'm going to highly leverage this example. So we're going to borrow like 80% of a purchase price. Most people actually put down more than that. So let's look at an example. This is a fake family in 2015. Let's say they had a gross a monthly income between husband and wife of $9,500, and they want to go buy a single family residence for $700,000, and they put down 20%. So they're going to go borrow $560,000. Their mortgage payment is going to be about $2,714 a month. Let's say that taxes and insurance are $450 a month, so their housing payment is $3,164 a month. Let's say they have other debt payments of a car, maybe, and so a couple of credit cards of $600 a month. So their total debt payments in this example are $3,764 a month. That gives them a debt-to-income ratio of 39.5%. That's well below the limit of 45% for most lenders. And for their other expenses before taxes, they have another $57 a month to spend on other expenses, including their taxes. Now, let's say that same family delayed purchasing and waited a year. And let's say prices went up 5%. So instead of paying $700,000 for that home, they paid $735,000. They still put 20% down. Now they're borrowing $588,000. Their mortgage payment goes up to $2,850 a month. Their monthly housing payment is now $3,300 a month, but their gross monthly income went up 2.4%. Now at 2.4% growth, you would think if housing went up 5%, they might have lost some ground, but that's not true when you look at the numbers. Even though their monthly housing payment went up to $3,300, let's say their other debt payments, let's leave everything else equal, now their monthly debt and housing is $3,900 a month. Their debt to income ratio actually dropped, and they actually have more money to spend on other expenses. Now, if we run these numbers at the national averages where people aren't borrowing quite as much as 80%, the truth is you can sustain a 5% increase in housing with a 1% increase in household income, and that's just the numbers. So it's a 5-to-1 ratio. You can sustain a 5% increase with a 1 in housing with a 1% increase in household income. So I think we've shown that, number one, there is not a housing bubble due to speculative demand for housing. Housing is not speculative. I don't see a lot of people out there that are buying homes just because they think they're going to go up 15 or 20%. People that are getting loans have been vetted a lot more than they did in the past, so they can afford the mortgage and they can weather a downturn, even weather a drop in their income. So we don't see any indication that the Hawaii market is in any kind of housing bubble, and in fact, we would think that we could sustain this for another 5 to 10 years very easily. So And a couple other things to look at. Foreign national purchases are actually down because of the strong U.S. dollar. So there isn't a bunch of money pouring in from foreign speculators. Um, Again, inventory is very weak and will continue to be weak. I don't see new home construction in Hawaii catching up for years. Okay. Um, Again, we have proven just in the history of the United States that we can sustain a 4.9% annual growth rate for 50 years. So this is nothing unusual. We're right about that same escalation. Um, and I do believe that we might see some softening in lending guidelines, and which would actually increase the demand for homes, and that would continue this escalation in real estate. Just as long as household income continues to rise at least a 5-to-1 ratio to housing prices, we can sustain it. Okay. So that's our conclusion. Again, we certainly don't believe we're experiencing any kind of real estate bubble. Um, and I do see as an investor, this is a very good time to continue to buy real estate. In fact, we're going to show you on another slide that real estate really is a hedge against losing a lot of wealth during a recession like you might in the stock market. And I really think the only way we're going to see any kind of major decline in housing values is if something happens worldwide. We go into a major world recession. We don't see any indication of that. The U.S. economy seems to be fairly healthy, could be doing better. But I mean, if there were some kind of outbreak of war, that might change things. But given everything as it is today, we see housing continuing to rise for another 5 to 10 years at the same pace it's been doing, unless, again, we go into a major recession. But even if we go into a recession, I'd rather have my money in real estate than the stock market, because typically real estate weathers recessions better than the stock market. And this is a good slide to show you that. The only time in the last 49 years, or actually 60 years, that we've seen a major decline in real estate values was in the last recession, and that recession was due to false demand in the real estate market that was perpetuated by lending practices that no longer exist. I remember seeing bartenders buying 2 and 3 condominiums with the idea that they would flip them in a year. They didn't have the money to support those condominiums. There wasn't enough demand in the rental market to fill them, so they were buying condominiums or houses or whatever it was, just speculating that they could flip it in a year and make $100,000 or something like that. So that's all gone. You don't see that anymore. People have to be, we have to prove that they have the ability to pay. So any buyer like that was over speculating in the real estate market, they're long gone. And frankly, I'm in the mortgage business. I see many transactions every single day. I don't see any of the people that we are lending to are really speculative buyers. They really are investors for the long term that will purchase a property. If they are not occupying as a primary residence, they're looking for a stable income coming from the property, and then they'll reap their reward as the property escalates in value. So that really does show you throughout all the other recessions in the history of this country over the last 60 years, real estate has very rarely seen much of a loss. I mean, you get the little peaks and valleys, but it only lasts for a year or two, and then you get your values right back. So as long as you stay in the property, again, real estate is actually a very good hedge to recession. If you look at the same graph in the stock market, it wouldn't look anything like this, that every time there's a recession, you might get a 10 or a 15 or 20% dip in the value of your equities. So again, I think that this is something to share. If you're a realtor, you share this with your buyers, that you can show them that the real estate market is a very good place to invest, especially here in Hawaii, because we are simply going to be, the demand is going to outstrip supply for as long as I can foresee it right now. and only a major change in lending policies is going to change all that. So thank you very much. If you have any other questions, you can reach me at 334-6201, and please share this with your